In this video, we're going to be performing a deep dive on Stanley Black & Decker's dividend safety. To begin, let's talk about Stanley Black & Decker's business model. Stanley Black & Decker is a world leader in power tools, hand tools, and related items. The company holds the top global position in tools and storage sales. Stanley Works and Black & Decker merged in 2010 to form the current company. Stanley Works traces its history back to 1843 when Frederick Stanley opened a small hardware shop in Connecticut. Black & Decker was founded in Baltimore, Maryland in 1910 and manufactured the world's first portable power tool. Stanley Black & Decker trades with a market capitalization of nearly $21 billion. Stanley Black & Decker is a well-known dividend stock because of its compelling track record of dividend growth. With 51 years of consecutive dividend increases, Stanley Black & Decker is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. In fact, Stanley Black & Decker's dividend history satisfies the requirement to be a dividend aristocrat more than twice over. With more than 5 decades of dividend increases, Stanley Black & Decker is not just a dividend aristocrat, but also a dividend king, an even more exclusive group of stocks with 50-plus years of dividend increases. Looking ahead, investors cannot rely on Stanley Black & Decker's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Stanley Black & Decker's dividend safety in the context of the company's current earnings. When Stanley Black & Decker reported fourth quarter financial results on January 22nd, the company announced that it generated adjusted earnings per share of $2.11 in the 3-month reporting period. For context, the company currently pays a quarterly dividend of 66 cents per share, which implies a payout ratio of 31% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Stanley Black & Decker generated adjusted earnings per share of $8.15 in fiscal 2018 and distributed $2.58 of common share dividends in the same time period, for a full-year payout ratio of 32%. Using earnings, Stanley Black & Decker's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Stanley Black & Decker's current dividend payment to its free cash flow. In the fourth quarter of fiscal 2018, Stanley Black & Decker generated $1.2 billion of cash flow from operating activities and spent $165 million on capital expenditures for free cash flow of approximately $1.1 billion. Note that these numbers do not add due to rounding. Stanley Black & Decker distributed $98.4 million of common share dividends during the same time period for a free cash flow dividend payout ratio of just 9%. This payout ratio is extremely low, and some investigation reveals that this may be due to a significant one-time operating cash infusion that amounts to about $350 million. Because of this, looking out over a longer time horizon may be useful. In fiscal 2018, Stanley Black & Decker generated $1.3 billion in cash flow from operating activities and spent $492.1 million on capital expenditures for free cash flow of $768.8 million. The company distributed $384.9 million in common share dividends during the same time period for a free cash flow dividend payout ratio of 50%. Using free cash flow, our conclusion is the same as when we used earnings to measure Stanley Black & Decker's dividend safety. The company's dividend appears safe for the foreseeable future. Although its payout ratio in the most recent quarter was artificially low due to non-recurring movements of cash within its business, companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Stanley Black & Decker's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Stanley Black & Decker's performance during this time period is shown here. Stanley Black & Decker's earnings per share declined by 32% peak to trough in the depths of the financial crisis. With that said, the company continued to cover its dividend payments with its earnings, and it continued its multi-decade streak of dividend increases. With that in mind, we do not have any concerns about Stanley Black & Decker's ability to continue paying its dividend during future economic downturns. The last angle that we will use to assess Stanley Black & Decker's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. At the end of fiscal 2018, Stanley Black & Decker had $3.8 billion of debt outstanding. The company generated $209.2 million of interest expense through the trailing 12 months for a weighted average interest rate of 5.5%. The following image shows how changes to Stanley Black & Decker's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, Stanley Black & Decker's weighted average interest rate would need to rise to above the 15% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that Stanley Black & Decker's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Stanley Black & Decker's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.